Welcome to Real Vision's Trade Ideas. Today we're sitting down with Tony Greer of TG Macro. Great to have you here.
Thanks, great to be here.
Now 2018 is coming to a close and it's time to review and reflect on all your trades this year. You've had a lot of different trades, from social media to emerging markets to oil and refiners. And so I want to start out, we'll go chronologically through some of your trades this year. You were on our beta platform for Trade Ideas, and you were talking about shorting home builders. Now, this was a winning trade. You were looking at shorting XHB and around the 40s level, and it actually went down to 30s. Where do you see that going now? Is that still a trade you would look to get into?
That was a good winner that finally fell in our lap all at once, and I took profits and took the trade off. That was speaking to, higher interest rates and a higher cost of capital for new home buyers up against sort of a very large inventory of homes in the United States. So as it turns out, the home builders themselves ran into a little difficulty, and the two consumer stocks, Home Depot and Lowe's, the big two names in the home builders ETF, finally curled over themselves with a couple of lower guidance quarters, et cetera, et cetera. So at this point, I would be looking to continue a short directionally with that trade, but I would need a better retracement to much higher levels before I could put out another home builder short.
Okay, so still something you'd look into doing, but wait for that to come back up.
Yeah.
All right, and your next trade of the year was in April when you came on to talk about Marathon, and so you were looking to buy it in around the 70s, and it actually ended up going to 85 or so it hit your target. What do you see going on there?
That was a great escape and a good way to stay disciplined with your trade targets, because we got into Marathon, I believe, in the low or mid 70s with a target of 85 into new highs, and we got that. So that was a good escape, but I still think that Marathon is a great play from the long side, especially down here just above the $60 level. Technically speaking, there's a double top back in 2015 at $60, and I love pullbacks to old highs. So I'm looking at that against the fundamental setup in Marathon, and I think Marathon is really well set up for next year. I think the dip in price is currently Marathon getting thrown out with the E&P bathwater. Right now we've got a situation where oil services stocks and E&P stocks are really getting crushed at the moment, and I think that the refiners are getting unduly crushed alongside them. I think Marathon is well set up. They just announced a $2.5 billion buyback in 2019. They are trying to raise their dividend. They are really well positioned for the International Maritime Organization sulfur rule, which takes place in 2020. And I mean, 1.8 million barrels of refining capacity a day and 5,600 gas stations across 19 states. I mean, Marathon Petroleum is the kind of company that I like to be long.
So you would definitely buy on the dip here?
Yeah, I like this dip to 60. I think it's great risk reward if you want to put a stop loss below that double top in 2015, at $58 or $57. I feel like it might take a little while, but Marathon should get back on its feet here.
And then you had another winning trade. So you came back in April and you talked about Citigroup shorting it. You were looking at it at $70 and it ended up going down to 65 and it continued to slide. What do you see going on there?
That was really me following my nose with a strong view to be short European banks. And then I believe Citigroup went and put in a big head and shoulders somewhere at the top of it and then broke down below moving averages. So I put a short out below the moving averages. I managed to stay with it. The stock is really coming off lately, but it's really more on the back of what's going on with the yield curve right now, and also possibly being led lower, the sector being led lower by Goldman Sachs, which has got a little bit of a sort of scandalous problem on their hands. So the Citigroup is something that, that was a really sort of reactionary trade to the technical pattern and my view on bank weakness generally speaking. So seeing that as I escaped that without getting stopped out, and right now the stock is sort of falling into my lap, so that's a stock that I would just take profit on the short and be out of the name for now. I'm not really sure what happens to Citigroup next.
Okay. And then after those winners, we had a nice streak of winners. We had a few losers. We talked about Scott's Miracle-Gro, that was later in May,
yep.
And you were looking to go long them. Could you talk about your thesis there and why that didn't necessarily play out?
Yeah, I tell you, the losers fall into the same bucket for me, not only as losers, but as sort of three trades in the middle of the year that I'm sort of forcing on the tape to figure out what's going to happen next. sometimes you don't mind making a small sacrifice, right? I'm getting bullish the cannabis space. I'm looking around for some stocks that haven't been picked through, or some names that might not be a direct benefit but will have a future benefit. I found a setup in Scott's Miracle-Gro that it looked like it was timed well, for a takeoff in the cannabis space. And I tried it. I respected my risk reward. I was wrong. I got out, moved on to the next one. Same kind of thing happened in Werner. I tried to buy Werner at about $40.
And that's the trucking company.
Yeah, the trucking company. And I was really trying to translate the tightness in the trucking space into a trade. And that was another trade that if you sort of stayed with that idea, you were able to find some really good breakouts in the trucking space. That I followed through on in my newsletter and on Twitter. But while Werner was wrong, we got a chance to buy Landstar, LSTR. That was another ticker that sort of did break higher. And I don't want to sound like I'm making excuses because it was a Werner trade idea, but we were sort of in the right sector at the time and just picked the wrong name. But seeing as we obeyed our stop loss and managed the risk reward properly, that's a trade that you just get out of and you look for the next one. Then I proceeded into Freeport-McMoRan because I thought it was pulling back to a significant level, and I thought that there was going to be a resurgence of the base metal rally that never really materialized. While the base metals didn't break down, Freeport-McMoRan really has never resolved the situation with their Grasberg partnership in Indonesia, so it's not clear on the tax implications and a few other of the logistics on the mining in Indonesia. So that whole setup has become what I thought was going to be a moment of clarity, became a little bit of an ongoing mess. So we had to stop out of the Freeport trade. And once again, if you respect your levels and get out where you say you tend to get out, you live to trade another day.
And then after all of that, you actually came back and had some winning trades. So you were looking to short emerging markets, specifically EEM, and you were looking to short that at 42. So you did quite well on that trade. Where do you see that one going?
I'm still bearish emerging markets.
Okay.
I still look at that as a function of the US dollar as a wrecking ball, right? I think that traders in the market are underestimating the strength of the dollar this year and next year. I think they're underestimating the path of U.S. interest rates, which while we are in a significant dip mode right now, the trend is still higher. And I think that shorting emerging markets is really a reflection of the stronger dollar. And what's happening there is that with the U.S. as a much more attractive center for investment than it was several years ago, people are being forced back in on the risk curve out from emerging markets, high yield, where they were sort of quietly hiding for the last 8 or 10 years in a very smooth ongoing rally, with President Trump sort of rearranging the tables on global trade and taking China away from the center of it. I think that's rearranging the calculus in the emerging markets trade quite a bit. And so I think as the U.S. draws more capital back here, and we've got liquidity issues trying to get out of emerging markets over there, the way I call it, I still think that we're going to stay with this technical trend, and the EEM ETF is going to continue to head lower.
Do you know how low?
I think it can trade into the low 30s or high 20s before I'm ready to take profits.
And then you had another winner shortly after that in September. You came to talk to us about social media stocks and the dangers that lurk there. So you're looking to short SOCL, that's a social media ETF, and you were shorting it at 32. You have a target of 25 right now. It's about 27. So you're on the way towards that target. Where do you see that going?
I still think it's going toward my profit-taking area in the mid-20s, to be totally honest with you. I still think there's going to be pressure on Facebook with losing monthly users, et cetera, and I think they've got a massive credibility problem. They just played, what I consider to be, a pretty interesting desperation card with a really big stock buyback, which is trying to turn the tide from the stock, which has turned lower. So I think that Facebook is battling having a really negative down year right now, and I think that if we end the year with Facebook down 20%, that people will think about carrying it around in their portfolios much longer. Staying short social media is also a reflection of being short Twitter. I think Twitter is, while I think it's a great platform to use, I think it's becoming well known that Twitter is a platform that is banning users based on their political beliefs, et cetera, and I just don't think that the way social media is going, that's going to be sustainable. So I think that Twitter has got a lot of risk in maintaining its users. I think it's got massive risk to competition coming in. If there's some kind of a decentralized platform, I don't see why we couldn't exchange thoughts and ideas on that. Maybe even more importantly, within the social media ETF, Google has finally cracked and backed off its highs. And while I think it's one of the more sustainable members of the FANG complex between Facebook, Amazon, Apple, Netflix, and Google, I think that now that the FANG complex has demonstrated the ability to go down and that they've got a massive sentiment issue on top of the tide turning technically, it's important that Google is also a major part of the social media ETF that's finally curling down below moving averages now, and they've got some credibility issues of their own. So I think that social media is going to finally fill me in on my profit taking in the mid-20s.
Do you think that now that it's at 27, going forward to 2019, that it could go below 25?
Put it this way, I'll probably take some off between now and the end of the year just to sort of pare down risk before the calendar flips over. But I would be looking to put any short that I covered down here in the low 20s back out in the mid 30s.
Finally, you came in October to talk about Canopy growth. Now, that was a losing trade, and we addressed that in a completely separate video, so we'll leave it for that.
Yep.
And then you came in last month in November to talk about USO and UGA ETF, a little bit getting into the gas and oil dip that was going on there. Where do you see that going?
The historic dip in the energy market. Well, so far so good, as they say in trading. You know, the market luckily stopped knifing lower right around where I thought it would. You know, when the energy market reaches historic levels and the spreads stop going down, and you see the speculative position turn from massively long to what is probably now at least slightly short into a support area, you get confident that you're going to get the bounce that you're looking for. And so that's where I am now. The latest headlines in the energy market that are relevant to this, I would say, are the 325,000 barrel per day cut out of Alberta, Canada. The Canadians are trying to sort of cut down on the Canadian oil discount to U.S. oil because they're building up so much inventory there because they have lack of a pipeline to get it out. So what they've done is gone ahead and cut 325,000 barrels a day out of Alberta. That was totally unexpected, and that should be a bullish implication for the oil price. OPEC has gone ahead and I guess under-promised and over-delivered in some ways by offering a sort of 800,000 barrel to 1 million barrel per day cut going into their meeting in Vienna last week to coming out of that meeting with a 1.2 million barrel per day cut. So, so far what's going on is that we're still seeing builds in inventories and oil continues to pound the $50 level. So the way I see it is we're still in the 8th or 9th inning of this sell-off from $75 down to $50. The gasoline market is holding in because there's decent demand. The heating oil market is holding in because the market is extremely tight. There are very low supplies and there is extremely high demand. It's a proxy for diesel fuel. Heating oil also fell to a trend line and is now picking itself back up off of it. So I still think, I'm really optimistic for the oil and gas length from here. I still think that you want to stay long USO up above $10 and long UGA above, I would say, call it $25, just broadly speaking. And I'm looking for the next price move to confirm that I'm right. And somewhere within that price move, I want to be long a hair-raising amount of oil and gas somewhere for that transition period when I'm being proven right and I can go for that little ride with a very large position and then get back to fighting weight at a next resistance level once the trade confirms that it's going my way. And I think we're almost there. I think at the WTI crude oil market needs to get back up above 54 or so, which has been the recent range top in the sell-off. So once we get above that range top, I think that crude oil continues higher.
So don't get too freaked out by a little bit of turbulence.
Not at all.
All right, well, we covered so many different topics this
Covered
year.
a lot of ground.
So now I got to know, what are you going to be watching in 2019?
I hated to give it away at the beginning of this interview, but I am definitely looking at Marathon Petroleum as one of my big ideas for 2019. I'm looking at a strong dollar as one of my big ideas for next year. And I'm trying to prepare equity traders for an even higher volatility regime than we're in right now for next year. So there's a lot to think about for 2019. That's probably a video all by itself.
So the dollar, the VIX, and oil. All things to keep an eye on. Well, we'll have you back in 2019 to talk about it.
Be plenty to talk about, right?
Great. Tony, thank you so much.
Thanks for having me.
So Tony revisited his trades from 2018. His big winners were shorting home builders, Citigroup, social media, and emerging markets, as well as going long Marathon Petroleum. On the other hand, some of his losers include going long Werner Enterprises, Scotts Miracle-Gro, Freeport-McMoRan, and Canopy Growth. While Tony does not have an update on Citigroup, Scotts Miracle-Gro, or Werner Enterprises, he still is interested in shorting home builders, but now suggests waiting for a bounce higher to enter the trade. He also likes buying the dip in Marathon Petroleum, ticker symbol MPC, around $60. His stop loss for the trade is $57. In addition, Tony is sticking with his short emerging markets thesis and thinks the iShares Emerging Market ETF, ticker symbol EEM, could reach the high 20s. Tony also suggests staying short the social media ETF, ticker symbol SOCL. He likes adding to the position in the mid-30s and would take profits in the low 20s. And for his last trade, he's bullish on oil and gas. He likes staying long the United States Oil ETF, ticker symbol USO, above $10, and the United States Gasoline ETF, ticker symbol UGA, above 25. Just remember that these are all trade ideas and not investment advice. You should do your own research, consider your risk tolerance, and invest accordingly. For Real Vision, I'm Justine Underhill.